Let me now bring on board Amitabh Sonthalia, Managing Director and Chief Executive Officer of SKS Capital. Amitabh, morning. Delighted to have you back on ET Now. Amitabh, Indian markets of late have been slightly sluggish and toppy. So what is dragging us down? What to your mind are some of the key issues which are bothering the bulls?
I think the chief worry is oil prices and the fact that they can't be passed on to the consumers in India like in the West. So because of high oil prices leads to high subsidies, which leads to higher deficits and crowds out. Higher deficit means higher government borrowings, which means crowding out of private investment and higher rates. And the other way high oil prices work on interest rates is it leads to, it's inflationary by itself, and which again, leads to, would prevent RBI from cutting rates, and therefore, so both the impact of, actually high oil prices in India works in a dual way to keep inflationary pressures high, subsidy effects high, and therefore leaves less room for the RBI to cut rates aggressively. And, so oil, interest rates and politics would be my three key worries for the markets.
Manish, fire flows in April have slowed as well as reversed. Are the markets looking for some sort of direction?
Yeah, so I think too much is being made of FII flows, and that cannot be the sole reason one can always be bullish on the markets. In the first 3 months of the current calendar, we saw almost $9 billion of flows. Now, this data is not corroborated by EPFR, which tracks institutional money, and the numbers that I think I saw EPFR reporting was somewhere around 2 billion for the first quarter. So this implies that most of the flows that we've seen in the calendar year so far have been from hedge funds and proprietary desks, etc. The so-called hot money, if you will. And if this money flows out, it could be very damaging for the market.
So, Amitabh, why are domestic mutual fund sellers, seeing some lack of interest among domestic investors right now?
Yeah, I think, if you look at the Indian equity markets in the last 5 years, we've really not delivered much returns domestically to investors. And I think the funds flow from retail investors to mutual funds or even directly to the markets are quite anemic. And, the DII money is really more of a reflection of the Indian household money going into equities, which has been poor. I think the chief reason for that is high debt returns in India. In India, the notional returns are quite high compared to the rest of the world. So equities as an asset class is less attractive when you're getting high fixed income returns. On the other hand, globally, the fixed income returns are very low, and therefore, which are very supportive of global equities. But in India, it's quite the reverse. So I think the sweet spot for equities is when alternatives are less attractive and valuations are dirt cheap, like in early 2009. And we somehow don't seem to be in that situation right now in India.
Manish, tomorrow is the April credit policy. What are your expectations? And tomorrow, if we get a clear indication from Reserve Bank of India of a rate cut, how do you think markets are likely to react to that?
Yeah, so I think given the IIP the weakness in the IIP numbers and the revision in the Jan IIP numbers, so there is a strong case for a rate cut tomorrow in the RBI policy. I think a 25 bips rate cut is somewhat priced in, and the banks and the markets in general, and specifically the Bank Nifty, rallied about 4-5% in anticipation last week before they corrected in the latter half on Friday. So, I think up to a 25 bips rate cut, markets may not react too much either ways. I don't expect a more aggressive rate cut at the moment, and but in case that does happen, I think markets would be positively surprised, and there would be further upside based on that event itself. On the other hand, if the rate cut doesn't materialize for some reason, then we're in for a rude shock for the markets.
Amitabh, in such a scenario, how do you propose one should approach rate-sensitive stocks?
The rate cuts and market performance really don't have any meaningful correlation. In fact, if you look at the recent run-up, look at the recent upcycle of 2010, in the initial phase, the repo rates went up from 4.75% in March 2010 to about 6.25% in November 2010. So it went up by roughly 150 bips, which is a pretty sharp increase in a short span of time. But interestingly, the bank Nifty went up by 50% during the same period. So if the rates and the bank stocks were positively correlated then in an upcycle, I don't see any reason why there should be an inverse correlation now if the rates fall modestly over the next few quarters. And so I'm worried about the banking sector because of the current ground realities, such as high cost of short-term funds, structural liquidity deficit, and high government borrowings, and prospects of record NPAs and restructured loans in the sector, which makes me hard to be bullish on the banking sector as a whole.
So, Amitabh, what sectors are you currently focused on, given the kind of market environment we're in?
Yeah, we are not so much sector focused in general, but I think generally financially strong mid-caps trading at undemanding valuations should do well, and hopefully stock picking will pay off rest of the year, even if the overall trend in the market is not very supportive. One company that we kind of found interesting was Manappuram Gold Finance post the recent sell-off. I think people are writing it off as another SKS microfinance, but I think the key difference between Manappuram and SKS Micro is that the former, which is Manappuram, does collateralized lending, whereas SKS Micro did unsecured lending to farmers, etc. And the recent regulatory changes, though, will affect growth and might slow down the growth of the company. I don't necessarily think that's bad for the company's financial health in the long run. So after almost a 50% correction in the last few months, we find the risk reward favorable in Manappuram at one-time book and perhaps 5x consensus estimates on earnings. And the key risk, of course, is gold prices. So as long as gold prices are somewhat stable at current levels, I think this stock should do well, given post the sell-off.
So finally, Amitabh, you've been stock specific. What about your disclosures?
I think it's safe to assume that whatever stocks or sectors I've spoken about and the views that I've expressed, I have a vested interest in that, and I may have positions in the stocks and sectors that I spoke about.